Beikox going hand in hand with asset allocation. The fund manager must consider the degree of diversification, which applies to a client under their risk appetite. Accordingly, a list of planned holding will have to be constructed deciding what percentage of the fund should be invested in a particular stock or bond. Adequate diversification requires the management of the correlation between the asset and liability return, internal issues about the portfolio, and cross-correlation between the returns. What are fund management styles? There are various fund management styles and approaches. The managers using this style have a lot of emphasis on the current and future corporate earnings. They are even prepared to pay a premium on securities having strong growth potential. The growth stocks are generally the cash cows and are expected to be sold at prices in the northern direction. Growth managers select companies having a strong competitive edge in their respective sectors. A high level of retained earnings is the expectation for such scripts to be successful as it makes the balance sheet of the firm very strong to attract investors. This can be coupled with a limited dividend distributed and low debt on the books, making it a definite pick by the managers. The scripts which are part of such a style will have a relatively high turnover rate since they are frequently traded in large quantities. The returns on the portfolio are made up of capital gains resulting from stock trades. The style produces stunning results when markets are bullish, but the portfolio managers are required to show talent and flair for achieving investment objectives during downward spirals. Beikox Growth Fund Management. Growth at reasonable price. The growth at reasonable price style will use a blend of growth and value investing. For constructing the portfolio, this portfolio will usually include a restricted number of securities that are showing consistent performance. The sector constituents of such portfolios could be slightly different from that of the benchmark index to take advantage of growth prospects from these selected sectors since their ability can be maximized under specific conditions. Managers following such a response will thrive on bargaining situations and offers. They are on the hunt for securities that are undervalued about their expected returns. Securities could be undervalued even because they do not hold preference with the investors for multiple reasons. The managers generally purchase the equities at low prices and tend to hold them till they reach their peak, depending on the time frame expected, and hence the portfolio mix will also stay stable. The value system performs at its peak during the bearish situation. Although managers do take the benefits in conditions of a bullish market, the objective is to extract the maximum benefit before it reaches its peak. This is the basic and one of the most defensive styles which aim to match the returns of the benchmark index by replicating its sector breakdown and capitalization. The managers will strive to add value to the existing portfolio. Such styles are generally adopted by mutual funds to maintain a cautious approach since many retail investors with limited investments expect a necessary return on their overall investment. Index fund management. Portfolios managed according to this style are highly diversified and contain a large number of securities. Capital gains are made by underweighting or overweighting specific securities or sectors, with the differences being regularly monitored. The managers using such a style rely on computer-based models that track the trends of price and profitability for identification of securities offering higher than market returns. Only necessary data and objective criteria of protection are taken into consideration, and no quantitative analysis of the issuer companies or its sectors are carried out. Beikox fund management. Risk factor control. This style is generally adopted for managing fixed income securities which take into account all elements of risk such as duration of the portfolio compared with the benchmark index, the overall interest rate structure, breakdown of the deposits by the category of the issuer and so on. The selection of the securities is based on the analysis of individual stocks with less emphasis on the significance of economic and market cycles. The investor will concentrate their efforts on a specific company instead of the overall industry or the economy. The approach is the company exceeding expectations despite the sector or the economy not doing well. The managers usually employ long-term strategies with a buy and hold approach. They will have a complete understanding of an individual stock and the long-term potential of the script and the company. The investors will take advantage of short-term volatility in the market for maximizing their profits. This is done by quickly entering and exiting their positions. Top-down investing. This approach of investment involves considering the overall condition of the economy and then further breaking down various components into minute details. Subsequently, analysts examine different industrial sectors for the selection of those scripts which are expected to outperform the market. Investors will look at the macroeconomic variables such as GDP, gross domestic product, trade balances, current account deficit, inflation and interest rate. Based on such variables, the managers will reallocate the monetary assets for earning capital gains rather than extensive analysis of a single company or sector. For instance, if economic growth is doing well in Southeast Asia compared to the domestic development of the EU, European Union, investors may shift assets internationally by purchasing exchange-traded funds that track the targeted countries in Asia. Thanks for watching.